Hello, everyone, and welcome to today's webinar on market insights for fixed income, where we'll explore the key trends and opportunities shaping the fixed income landscape. As widely anticipated, the Reserve Bank of India's monetary policy on 9th April decided to cut the policy repo rate by 25 basis points to 6%. The policy stance again was changed from neutral to accommodative, and this decision was taken unanimously. I'm Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, our head of fixed income, to provide you the deeper understanding of current market dynamics and share expert insights on fixed income markets. After Anurag's presentation, we'll open the floor for Q&A. Please feel free to submit your questions via the link provided throughout the webinar. Without further ado, let's dive in. Anurag, over to you.
Thanks, Sandeep, and hi, good day, everyone who's joined into the webinar. We hope you find it useful. It's been a very, very interesting month and even last week so far with a lot of interesting news updates globally as well as the RBI policy. So let's dive in. We'll start with the key global trends, and then we'll move on to the policy and implications for us as investors. So usually we start, discussing with how the trends are shaping up on the manufacturing and services. But the much more interesting and much more relevant chart is on your right-hand side, which is Bloomberg weighted economic policy uncertainty index and trade policy uncertainty index. So the trade policy uncertainty index is in the orange line, and the economic policy uncertainty index is the blue line. And as we can see, and the data going all the way till 2009, these indices are at its highest levels we have seen historically. The reason is one of the key, election planks of the new administration in the US, apart from tighter immigration and apart from deregulation, was tariffs. Tariffs on most of US trading partners to ensure that the US trade deficit gets controlled and, in fact, reduces all the way close to zero. Of course, at that point of time, many market participants thought that probably the hard line is a negotiating tactic, and once the administration takes over, there will be some tariffs, but probably it will be towards sensitive sectors, and overall business will go on as usual. And in fact, US may benefit from stronger political stability as well as deregulation, and hence, for the first 2 months of this calendar year, we saw the term coined as US exceptionalism, which largely meant that US economy will continue to grow exceptionally compared to rest of the world, driven by stability and overall deregulation, which will help drive business growth. In fact, the last month, as the US president announced various tariffs, getting into the reciprocal tariffs this month as well, the US exceptionalism has turned on its head. In fact, now the exceptionalism is happening in reverse, where the US dollar, US bond yields, as well as US equity markets are falling much more compared to the rest of the world due to the policy and economic uncertainty. One of the, again, key aspects of what's really, driving this uncertainty is that there is total lack of clarity on how the tariffs, which the US president announced on 2nd April, how they will be implemented and what will be the timelines and what will be the final shape and contours of that. So, given that these amount of uncertainties exist, it of course leads to slowdown in business and spending. And whenever there is a slowdown in business spending, there is typically a slowdown in business hiring as well. And as we see slowdown in business hiring, one of the key impacts of that is lower wage growth, lower job growth, and hence lower consumption growth as well. And that is what it is likely to really dominate for the next 2-3 months till we get clarity on the next trade policies for the US. So apart from the uncertainty due to trade policy, we are also seeing increasing trade fragmentation where the Eurozone, the US, and Asia Pacific are talking of setting up own supply chains. For example, Germany passed a very aggressive fiscal expansion plan last month where they want to set up their own defense capabilities. What it really means for this for the rest of the world is whenever compared to a world which was very well integrated and globalized, now you have a much more fractured world. What it means is broken supply chains, higher inflation, higher inefficiency, and that broadly it raises your cost of production, and consequently it raises your cost of consumption as well. So what we are looking at a world is where growth is slowing down, as well as potential inflation is likely to pick up. Having said that, we do expect global growth to slow down from probably 3.5% range to 1.5 to 2% range this calendar year, largely driven by European fiscal expansion. Like I mentioned, Germany, France, and the major economies in Eurozone are planning to expand on the defense production, are planning to expand on the key technology areas. And that's where we do expect some growth to pick up, at least in the near term. We also expect China to continue its monetary and fiscal stimulus to counter US trade restriction on Chinese exports to the US. So China will probably come up with more stimulus, and that may drive Chinese near-term growth, I would say more strongly. And that's where, I would say, would be the large two key drivers of global growth. So just to summarize what really happened on the tariff announcement. So on 2nd April 2025, what the US administration called the Liberation Day, which they termed as liberation from heavy imports, the new administration announced baseline tariff on 10% on all imported goods, which were effective from 5th April, and reciprocal tariffs from 9th April on individual countries subject to their trade deficit with the US. So the higher the trade deficit with the US and the higher the tariff that particular economic region was subjected to. So typically the tariffs were ranging from 10% to 49%. Of course, as the US runs the highest trade deficit with China, and there are also some geopolitical tensions between these two economies. The the tariff escalation to China was in the range of about 145%. So that's the most aggressive tariff which has been levied on any nation, which effectively means trade embargo with China for the US, because at 145% of the tariffs, it's simply unviable for China to export any good to the US. To India, given our lower trade deficit with the US compared to the rest of the world, our tariffs was lower, about 26%. But what it really means for the US consumer and US growth. So if you look at the chart on the left-hand side, so if you look at tariff as a share of imports, is the highest since 1910. So the tariffs are almost touching 24% as a percentage of value of imports, which leads to substantial inflation. So assuming a static import base, so of course, we are assuming that the destination countries will continue to be the same, but broadly, what it means is if US were to import the same composition of goods from the same countries, it can add about 1 to 1.5% of inflation this year. And given that it's a substantial, inflation, or in a way a tax on consumption. And given that US is a consumption oriented economy just like India, it reduces GDP growth by similar amount to of 1.5%, and probably could even lead to a technical recession or to consecutive quarters of negative GDP if implemented fully this year. So that's the kind of impact that can be seen. So for example, if you would see the chart on the right hand side, which broadly estimates the impact of reciprocal tariffs on real GDP growth, as we can see in 2025, it leads to a total cumulative negative impact on the US of 1% and 0.4% in 2026. For Mexico, the impact is slightly lower because they are not subject to reciprocal tariffs for now. They are the old tariffs which the president implemented in early March are still applicable. So the impact is probably not in 25, but in 26. China, again, we see a major impact in 26 as well, because there's an assumption that China will, unleash some fiscal as well as monetary stimulus. Broadly, what we see, we are seeing major impact across all the economy. So what does it mean for the global markets and for central banks? Of course, if we were to see this kind of inflation, which in a way, given that it's coming from tariffs, is largely a tax on consumers, it is leading to potential slowdown. And what is in a normal world, and in a static world, probably a higher inflation in the US would have meant higher interest rates in the US, and that would have meant higher dollar flows and probably strengthening of dollar. What really happened as a result of this announcements was actually dollar weakened. One of the reasons was that given the very aggressive and very volatile tariff situation, there is a perception amongst market participants that if these tariffs were to be implemented as they are, it could lead to major slowdown in the US, eventually, and probably would lead to more aggressive rate cuts from the Fed. So because the first order impact will be inflation, probably the Fed will not be able to respond immediately. But by the time Fed responds and that whole effect of inflation really follows through, Indian economy could lead towards in the US economy could lead towards a significant slowdown, and that's largely changed the reaction function on the dollar. Commodity index, as we can see, the commodity prices continue to go up for the month of March. Interestingly, while oil prices were down, so oil went down from 75 to almost 70, and now it's trading almost at $62, $63, where the commodities, complex continue to benefit from strong precious metal demand, because as market participants were expecting tariff announcements in April, there was a surge in shipments to the US, and which led to strong demand in gold, silver, and copper. So these precious metals gained by 10%, while oil prices and natural gas prices went lower due to concerns of global slowdown. If we look at the food price index, we saw the food price index gaining by 8%, and the highest since August 2022, due to higher dairy and vegetable oil costs due to supply constraints on account of weather disruptions in key export markets like Latin America and Eurozone. So if we look at how global bond yields have been behaving, so largely like we saw, for example, the Eurozone saw the biggest rise in bond yields, like we discussed during earlier in the presentation. So Eurozone is working aggressively on fiscal expansion to support growth, and also to decouple their defense policy from the US. That spending means higher fiscal deficits, and that's what we are seeing the impact. UK saw increase in bond yields about 19 basis. Germany saw 33 basis. As the market participants continue to realize that probably Latin America will not be hit hard with very aggressive tariffs from the US, we saw decline in bond yields in Latin America. If we look at Asia Pacific, apart from Singapore and India, we saw upward movement in bond yields in all the major economies due to again the impact of tariffs and disruption in these economies. So if we look at the US financial conditions index, as we can see, the financial conditions had eased in early part of this calendar year because of the expectations of US exceptionalism and better equities and better bond deals. Now that's started to worsen because as equity markets are falling, bond yields are rising. Overall, the view in the market is that there will be a lot of volatility. There will be probably hit at corporate profitability, which is leading to this impact on financial conditions. If you look at on the right hand side of the chart, which is the market implied policy rate forecast, what it really means is earlier market participants were expecting only 50 basis of rate cuts in this cycle. Now market participants are expecting more than 100 basis of rate cuts from the Fed due to the expected slowdown in the global economy. So now coming to the domestic trends and starting from the RBI policy. So broadly, when we were approaching the policy, most of the market participants were of the view that RBI will cut the policy rate by 25 basis to 6% as inflation continues to be quite comfortable. Growth is probably losing its momentum. One of the differential points in the market participants' view was that how will really RBI tackle its stance? Given that RBI had already injected 5 lakh crores of permanent liquidity in the system since last 2 months, there was a camp which was expecting RBI to change the stance to accommodative, which would have meant probably that liquidity will continue to be surplus. Your overnight rates will continue to be lower than probably policy rates. Until the time RBI will keep it surplus, at least till the time RBI wanted to ensure monetary policy transmission and wanted to keep financial conditions easy. There was another camp in the market which believed that given that global economy is going through volatile times, currencies are going through volatile times, it will be probably more prudent for RBI to keep the monetary policy stance at neutral, which may give RBI more flexibility to respond on the other side as well, both on liquidity or rates, if tomorrow global financial conditions get very volatile. But having said that, RBI, while it acknowledged the impact of global economic policy uncertainties on growth as well as on inflation, it not only changed the stance, but it also changed the paradigm of the stance. So typically, what market participants have associated the stance of accommodative is one that, yes, the next move is probably a cut or a hold, but what also means is that liquidity management will be easier and RBI will keep liquidity easy. So RBI very explicitly in their press conference differentiated between the stance and liquidity management. They explicitly mentioned that they will keep liquidity at surplus of 0.5 to 1% of NDTL. Given that NDTL is in excess of 200 lakh crores, it means that they will let liquidity be somewhere between 1 lakh to 2 lakh crores of positive, and which means that overnight rates could be lower than policy rates. The second big change was that they said that how they are interpreting the accommodative stance is that they want to keep rates lower to support growth. What that really means is, and what is more even constructive for the market, is that they are likely to keep rates lower and in fact cut them further to ensure that they support growth. And why do we feel that? So if you look at the second table on the right hand side, which is RBI estimates for real GDP growth, Largely, if you see, RBI is expecting 6.5% growth for FY26 compared to 6.7 in February 2025. And it's just a 20 basis downward movement due to global uncertainty. But global, we would say that, the impact of global uncertainty or this tariffs will not just be on India's immediate exports. It will also be on the investment sentiment. It will also be on the hiring sentiment. It will also be on the consumption sentiment. So the probably, at some point of time, even these growth estimates could get revised downwards. What that would mean is probably, and the second comforting part is RBI is also expecting inflation to be lower at 4% for FY26. So, in nutshell, what we mean is if we are expecting lower growth and inflation close to RBI's target of 4%, RBI can easily cut rates by 50 basis points from current level. That is, we expect RBI to cut repo rate to 5.5% in this monetary policy cycle, given that they are quite comfortable on inflation and they do expect growth to slow down from here on. Secondly, given that we are looking at a easy liquidity, that is also very constructive for shorter end of the yield curve, which should keep rates at the short to medium end quite anchored. So broadly, if we look at the inflation trajectory, RBI is quite constructive on, like we saw in the last table also, on the inflation trajectory as one of the major determinants of inflation in the last 24 months has been food inflation, and especially the volatility in vegetable prices. As that has now come down, there has been abundant arrival of vegetables in the food market, and we are seeing this slowdown in inflation, and that's why probably RBI expects inflation to remain well controlled during FY26. If we look at the CPI diffusion index also, and we look at constituents which are greater than 5% inflation, that continues to be quite stable, shows that inflation is not really broad-based, but a very few items of inflation really driving it. As they slow down, they stabilize, we do expect inflation to remain quite healthy. So if we look at specific tariffs, impact on India, what we see is, yes, India has had lower tariffs than the rest of the world. But if we look at, India's exports to the US, and if we look at, compared to other countries, US forms the largest market share for India's exports, almost 80 billion. And even if we assume a 10% decline in value of India's exports to the US, the total impact on India's growth is likely to be around 0.2%. What's more important is what we have to see, a large part of India's exports to the US comes from pharmaceutical sector, and which is subject to probable some tariff exemption. So if India were to get some tariff exemptions, then probably the impact of tariffs on India will be more moderate. More importantly, it's not just about specific impact on exports. Like we discussed previously, the indirect impact on India of these tariffs can come via currency depreciation, which can lead to some inflation, and also due to lower capital flows, that is lower FDI and lower FPI flows, which could lead to some impact on FX reserves as well. So broadly, we are seeing three-pronged impact of tariffs on India. One, on growth, which would be slightly negative. One, through currency, because as other countries also start to depreciate to counter higher tariffs, rupee, even if the government of India does not intervene through our, through any measures, it may still lead to some, inline depreciation for the INR as well, and we may also see some impact on capital flows. That's something which we will have to watch out for. If we look at how India government response has been, so they are already working on the bilateral deal with the US. So what the US government has been asking its trading partners, that either they buy more from the US or they subscribe to US bonds at very lower interest rates. So what probably India is working on is wherever there are some gaps in local production. India is trying to fulfill that gap through more imports from the US. It's working with the US on more defense equipment, oil, and LNG, which will probably satisfy the demands from the US administration, and probably the tariff impact on India will be more moderate than what we are currently penciling in. So that's something, it's a very fluid situation. It's an evolving situation. Probably that clarity will come in the next 3 to 6 months. If you look at RBI intervention, so not only RBI is easing monetary policy, it's infusing sufficient amount of liquidity in the banking system. So as we can see throughout February and March, as well as now going into April, RBI is infusing more than 5 lakh crores of liquidity in the banking system, which has led to slowdown or fall in MIBOR rates. If we look at average system liquidity, it reduced to 1.2 trillion compared to 1.6 trillion in February, despite the advance tax outflows. In fact, if we look at current system liquidity, it has turned to surplus by about 2 lakh crores, and we expect it to remain positive in the whole first half year of FY26. So why do we say that? If we look at, this is the liquidity forecast, taking into account with the various inflows as well as the various outflows. So if we look at the various inflows, typically what are the major inflows in banking system? It's the majority of government bonds, the SDLs plus the interest income, plus the RBI dividend or any. What are the typical outflows? What we see is currency, which basically means a currency going out from the banking system into the pockets of consumers, the T-bill, GSEC, and STL issuance. If we add everything what we expect in next 3 months, where we do expect liquidity to go from 80,000 crores at the beginning of the April all the way to 4 lakh crores and above by the end of July. So that's the kind of swing in liquidity which we are expecting, largely due to RBI dividend, which we expected to be about 2.5 lakh crores. So we do expect overnight rates to remain comfortable, and we expect both system and core liquidity to be in surplus in the coming months. Just as a clarification, system liquidity is what the interbank system lends or borrows from each other. But if you add the government cash balance to it, because government cash balance ultimately gets back into the banking system, that forms your core liquidity. So we do expect both system and core liquidity to be in surplus in the upcoming months. So if we look at credit deposit growth, the credit deposit gap continues to shrink. We saw credit growth easing to 11% and deposit growth slowing to 12.3%. Industry growth as well is slowing as well. Largely, it's the personal loans. Probably in February, it was the gold loans, and which saw a very sharp rise. In fact, in this policy, we saw some tightening of credit lending and standardization of lending standards from the RBI. So we need to watch this space at how gold loans or personal loans continue to evolve in the upcoming quarters. So we also saw the release of the borrowing calendar from the RBI for the first half of FY26, so and the T-bill calendar for first quarter of 2026. So broadly, as we can see, the H1 FY26 borrowing calendar was quite well distributed compared to H1 FY25 as well. There was some reduction in the greater than 30-year space, which was offset by some increase in the 1 to 4 year and the 5 to 9 year space, which is logical also that as we come into the rate cut cycle, the curve will get steeper. There will be more demand for 3 to 5 year segment rather than 30-year plus segment, which should see some tapering of the demand. And hence, the borrowing calendar is very favorable as it caters to the demand supply dynamics of the bond market. So we do not really expect any disruption in the bond market due to the borrowing calendar. If we look at the T-bill calendar as well, the T-bill calendar is about, on a net basis, 64,000 crores negative, which means that there are higher maturities than issuance of up to about 64,000 crores. As far as competitive bids in T-bills are concerned, largely they are due to better cash management and higher government cash balance. So rather than issuing higher T-bills, government is utilizing its cash balance, is issuing less T-bills and also saving on interest costs. So as we can see, the sovereign curve it has started to steepen compared to the previous year where it was largely flat. We do expect the curve to steepen, continue meaningfully in the next 3 months as we see more liquidity and more rate cuts. So we look at the overall yield curve, whether we look at sovereign, AAA or AA, we all saw easing of yields on the expected policy easing in, you know, April policy, and that's largely materialized. So we do expect yields to continue to come down in the next 3 to 6 months. So as far as the fixed income outlook is concerned, I think as we had said in our beginning of the year outlook that which was titled "Chaos is a Ladder." What we really meant was that this year, because there are so many moving parts, there are so many negotiations happening on geopolitics. There's negotiation happening on Russia, Ukraine. There is negotiation happening on tariffs. There are negotiations happening on tax cuts in the US. Given that there are moving parts, there will be news, there will be disruptions. But as investors, what we can keep in mind is where we are in the business cycle. So if we look at the business cycle, that was slowing at the beginning of the year, that's slowing right now as well. That is likely to even slow down more because of the uncertainty created by the tariff and other geopolitical policies. So whenever we are seeing a slowing global growth momentum, it largely means that interest rates at some point of time will have to be cut to reinforce the growth outlook by most of the central banks. What makes it even better for India is that if we look at this, the cycle of inflation, while growth momentum is slowing, at the same time in India, at least compared to the rest of the world, inflation is also slowing down. So in the last 2 years, that high inflation that we saw due to higher food prices, that all is now normalizing. And even RBI has expressed greater confidence that inflation over the next 12 months will remain durably aligned to its 4% target. So you have a period of easy inflation and slowing growth, which we think opens up space for at least 50 basis of rate cuts in the current monetary cycle, which broadly means that given that RBI is committed to providing easy liquidity, we should see stronger performance of the intermediate duration, which basically means from 3 months to 5 year segment. And hence, we think the moderate duration products possibly provide the optimal risk-adjusted returns in this scenario of a deeper rate cut cycle. What it really means for investors. So investors who have a 6 to 12 months investment horizon can consider allocation to low duration and money market strategies. And investors who have an investment horizon of more than 12 months can consider allocation to moderate duration strategies. But fixed income allocation is something which every investor should consider, depending on the risk appetite, but they should consider in this monetary policy cycle. This is likely to be a slightly deeper than expected monetary policy cycle, given that we are likely to experience a reasonable amount of growth slowdown in this calendar year. So that was largely from my side. Thanks a lot for listening in. We are happy to take up any questions that any of you may have. I would request Sandeep to open the floor to questions. Thanks.
Thanks, Anurag, for your valuable insights. And we'll move on to the questions. So the first question is that what will be the impact of currency fluctuations on the fixed income instruments?
So, it will depend differently for different countries. Economy which is running a strong trade surplus, like a South Korea or a China or a Japan, a weaker currency makes their exports even more attractive. So the impact for weaker currencies on them is better. If we look at countries who run a trade deficit, such as India, for example, or Indonesia, for them, weaker currency means higher inflation on the margin and probably slightly negative for growth. So again, fluctuations matter, but broadly, if ultimately fluctuations in any currency come about depending on their macro stability. So for example, if a country is stable in terms of fiscal, stable in terms of inflation, uh, over a longer period of time, the currency should not fluctuate materially and relatively. While in the near term, yes, currencies are subject to various pulls and pressures from flows, but over a medium term, ultimately, it's the macro stability of any economy which matters for currency volatility.
Okay, thank you. So the next question is from Kamna Dhanuka. How many more rate cuts do we see further and the consequent GSEC level?
We do expect further rate cuts of 50 basis points this monetary policy cycle. So we expect a terminal repo rate of 5.5, assuming no major disruption. Um, on the terminal rate, so typically, if you see the 10-year benchmark over a steady state has anchored between 80 to 90 basis over the policy rate. So assuming a 80 to 90 basis spread over the policy rate, we over a long to medium term, we do expect 10-year to trade between 630 to 640. While in momentum, like I said, these ranges can be broken on either side. But largely, if you were to take a single anchor of the bond yield, probably it will be between 630 to 640.
The next question is from Amit Shigwan. There is the theory circulating that US wants to refinance its debt at lower interest rates. And to do it, Trump is imposing tariffs. What is your take on this? And if this is true, how will it impact US and other countries in long term?
You're right, that's one theory, but to be honest, it's very difficult to second guess the US president that what he really wants. But as far as the let's say the likelihood of this scenario, coming through, uh, you know, it totally, if you look at the US debt to GDP, now it's more than 100%. And if you look at the US economic model, what essentially is US economic model is that it imports goods and it exports its dollar, because dollar remains the strategic currency for the world. It's a reserve currency for the world. What that means is any central bank which wants to build FX reserves devotes a considerable part of their FX reserves in dollar terms. When any economy, especially which is a reserve currency, uh, they have these volatile tariff policies, which have these extreme tariff policies, ultimately leads to I would say depletion of trust with the trading partners, and over a longer period of time, it may lead to central banks diversifying away from dollar. So if you see, one of the moves which has happened in last 12 months is a very strong move in gold. And one of the reasons why gold is doing so well is that major corporations, major economic agents, including central banks, are accumulating more gold right now because they want to reduce dependence on dollar. So while one, if the recession were to happen, probably in the near term, US may get the benefit of lower interest rates. But if uh, these volatile policies lead various nations to reduce their dollar dependency, it may lead to higher rates in the medium to long term, because one of the major buyers of US bonds is global central banks. So in the near, so I'm not sure whether US president wants to achieve this recession, and whether they will be able to refinance at lower rates. But if that view were to be true, probably it may not work out over the medium to long term.
Interesting. Speaking of gold, we have one question. What's your view on gold from Prakash Tharwani?
See, we don't trade gold, and we don't follow gold as far as the valuation is concerned. But I would say, given these volatile times, especially from currency and fixed income point of view, gold should continue to be a major part of allocation for major economic players and may continue to find support in various central bank and various hedge fund and other fund purchases. It's very difficult to prescribe a valuation to gold because right now it's being used as a hedge. So it's really difficult or to give a valuation to gold right now.
Okay. So the next question is from Jack D'Souza. He's asking that the JP Morgan Emerging Market Index, which included India in July 24. So can you tell us which tenor is the most subscribed uh, tenor, and what could be the reason for flattening of the curve from here?
Uh, so 5 to 10 year, I would say segment is the most subscribed segment as far as the JP Morgan bond index flows are concerned. The second question regarding what would be the reason of flattening of the curve? So we are not of the view of flattening of the curve. We are of the view of steepening of the yield curve because we are already in the interest rate easing cycle. Typically, in any interest rate cycle, it is consistent in India as well as globally. Before the interest rate cut cycle, usually the curve flattens in the anticipation of interest rate cuts. But once the interest rate cuts are initiated, it's the short end of the yield curve which typically outperforms the longer end because most of the positives were priced in the long end. The short end takes time to get priced in because they can only react, the short end can only react when the actual rate cuts are announced, when actual liquidity easing measures are taken. And that's what's happening in India, that's what's happening globally, for example. So we do expect curve to steepen, not really flat.
The next question is from Amit Gupta. Which category of fixed income fund should one consider given he or she has the investment horizon of 2 to 5 years?
So again, it depends on the risk appetite and depending on the nature of the investor. But I would say that especially investors who are subject to higher marginal tax rates, they should consider fund of fund structure because they are giving you stable, predictable returns, and they can give you a taxation of 12.5% as per the current taxation regime if one were to stay invested for two and more years. So, for example, for the same return from a debt fund and from an FOF, the marginal tax rate would be more than 30%. For an investor in the 30% tax bracket, but out here it's just 12.5. So there's a significant tax advantage, and without compromising too much on stability of returns. So that's something which we do recommend investors to consider when they are looking at fixed income allocation.
Perfect. So the next question is, a rollout of the government expenditure projects has slowed down in the current fiscal and is adding strains to economic activity. While it can be partly attributed to moderation in the growth outlook and uncertain global environment, could there be any incremental risks of tempering long-term growth outlook for India?
So apart from slowdown in government spending and global uncertainty, the third factor which we have been highlighting for a while now is slowdown in domestic consumption. So like we have been highlighting that 60% of India's economy is driven by personal consumption, which has been subject to reduction in disposable income, slowing wage growth, slowing job growth, and and that's been for a while. And is in fact the last 12 to 18 months, one of the reasons for higher personal loans was that people were fulfilling their consumption demands from leverage. And as that leverage has started to slow down, we do expect that personal consumption will also slow down. So probably, the economy is facing a confluence of weaker export growth, rising global uncertainty, moderation in government capex, as well as slowdown in domestic consumption as well.
Okay. One last question we have now. While there is a rise in electronic manufacturing services, opening the door for new job creation, could there be a paradigm shift happening in job landscape of India's shifting concentration from agricultural to construction, agriculture and construction?
Uh, Agriculture and construction too, which sector?
EMS, electronic manufacturing services.
Right. So, like I said, while India has better tariff advantages than some of the other nations, there are two questions which we will need to answer to really assess whether India can benefit from, the shift to electronic manufacturing services. Is one, uh, is India really competitive with rest of the regions after adjusting for the tariff? So, for example, there is Vietnam, which is subject to 36%, and we are at 26%. Is our competitiveness within 10%? So, if our competitiveness is within 10%, probably we may see some benefit where some manufacturers shift from Vietnam or Malaysia or Thailand to India, given our lower tariffs. But if our capital cost, taxation, etc., is higher than these countries, then even the lower tariffs may not help. And the second point, mind you, is if you look at South Korea, Germany, and other countries, Australia, and so on and so forth, they are subject to much lower tariffs than India, and they also have a reasonable base uh, in electronic manufacturing. So, if these countries were to really support electronic, manufacturers, uh, probably India may not benefit as much as we are expecting right now. That's the first point. So, one, our competitiveness has to be better than the tariff differential with the rest of the world. Second point, given that negotiations are still happening, right? No sound manufacturer at this point of time will commit themselves to a large capex plan given the uncertainty, because the tariffs that are announced right now are subject to negotiations between the US administration and those respective countries. So till a manufacturer is, quite clear that the tariffs which are announced are final after the trade negotiations, probably that is the time we will see large pickup in capital spending from the private sector, irrespective of the economic region. So I think it's too early for India to say that they can benefit. One, we don't know the competitiveness with respect to the tariff differential. Secondly, given that the US administration has given a 90-day pause for negotiations with respective countries, people are likely to wait for those 90 days to see the full impact and then probably commit themselves to any capital plan.
Great, very well answered. So you have addressed all the questions, Anurag. Thank you so much for your detailed insights. And audience, thank you for joining us today. We hope the insights shared by our expert have given you clear understanding of the current fixed income market, the opportunities ahead, and how you can adjust your investment strategies accordingly. We value your time and participation today and look forward to welcoming you in our next event. Until then, stay informed, stay ahead, and thank you again for your attention.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.